All right. Good morning, everyone.
Morning.
Good morning.
Good morning, everybody. As we come in, if you all could mute yourselves, that'd be super helpful. We're going to take a minute, and then we've got a lot of folks joining. So we're going to take a minute. We are recording already because we've had a lot of people ask for this. So if you'll, like I say, just hit mute and then give us a minute to let everybody in, and then we will get rolling. Robert has a presentation already for us, and it's very in depth. So we're ready to we're eager to go. All right. Well, good morning. I know a few more people just joined us. If you'll do us a favor and mute yourself, that'd be fantastic. And then I'm going to do quick introductions and then we're going to get rolling because we've got a lot to get through. I'm also going to reiterate for folks that just joined us, we are recording this. So we will send this out afterwards. If you know somebody who can't join us or if there's someone on your team you want them to see it, I'm happy to send that out as soon as we're done. So quickly, introductions for y'all. I'm Matt Willie. I'm the manager of regulatory advocacy here at the league. I deal with all of our different regulators on the state and the federal level. And that's kind of my role here with the four-state imprint we've got. And we have partnered with TruStage on this webinar today to help us bring Robert to you as well. I'm going to let Brian and Christopher introduce themselves real quick, and then we'll introduce our speaker.
Brian Geenan with TruStage. I'm in the Corporate and Legislative Affairs Department, and so we work with the league and the advocacy units of the league to set our credit union advocacy agenda so that it aligns with our credit union partners to create the best business environment for credit unions. And so I just want to say thank you all for joining us today. We really appreciate it, and we have a great presentation on deck.
Hey, good morning, everyone. Name's Christopher Hodge, Senior Director of Government Affairs here at the League, primarily based in Florida advocacy, spend a lot of time in Tallahassee, as well as around the footprint throughout Florida. On the road, hear a lot about affordability and insurance, and it's definitely on the mind of our legislators. So I spend a lot of time in the Capitol talking about that. So happy y'all can join and looking forward to today.
Yeah, and as Christopher said, this kind of idea for the webinar came from our members asking about this and us wanting to provide a resource for everybody. So we have with us today Robert Gordon. He's with the American Property Casualty Insurance Association, and he has been working with them for since for many, many years now. He's also he develops and frames their public policy positions on opportunities and challenges facing property casualty insurance at the state, federal, and international levels. And then he does all of their policy support, I should say, for their state and federal advocacy efforts, including media outreach and information products. And he had the same title before they actually did the merger with the Property Casualty Insurers Association of America in 2019. So he's joining us today. He's got a comprehensive presentation on this, and I'll let him start sharing his slides and introduce himself a little bit more if you'd like. One more reminder for folks that just joined us, if you haven't had a chance to mute yourself, please go ahead and do that. And we are recording this, so just FYI. And then if you have a question, you can put it in the chat. We will do questions at the end. And Robert has graciously said if you have a burning question during the presentation, he will try to answer it. So I'm gonna be quiet and get out of the way.
Well, thank you, Matt and Brian, and thank everybody for the discussion today, and a special thanks to TruStage, one of our leading insurance company members. APCIA is the primary property casualty insurance trade association. We represent about two-thirds of the home, auto, and business insurance industry. And I wanted to share with you today some of the challenges that we face that particularly impact credit unions. This first slide won't be a surprise to any of you. Housing affordability is at its worst level since the 1980s. Not coincidentally, that was the last time the US economy experienced record inflation and high interest rates. And you can see on the right side how housing prices are rapidly escalating compared to median income. So that's really one of the top sources of pressure we're seeing in the financial industry. And homeowners insurance is only a relatively small percentage of the overall cost of home ownership. It's a bit more than home maintenance, but much less than the property taxes and mortgage costs. But homeowners insurance rates have been increasing significantly over the last several years. And we'll talk a little bit about in the next 20 minutes about why that is. And as Matt said, I welcome your questions at any time as well as at the end. So the real pressures on the insurance side is that the insured losses, property insurance losses in the US have been rapidly escalating. And that's been from a combination of record inflation, demographic shifts, economic growth, increased natural disasters. Insurance is just a pass-through of those rising costs. So when losses go up, rates go up. If losses go up faster than rates, then insurers don't have enough capital to meet the increasing coverage demands. And then the affordability challenges transform at that point into availability crisis. The left graph shows the net underwriting results of the property casualty insurance industry over the last 10 years, how much the industry takes in versus how much it pays out in claims and expenses. And you can see that, yes, our profitability did improve in 2024, but it was not quite enough to offset the losses in 2023, and the industry still had a $47 billion cumulative underwriting deficit over the last decade. Wow. Now, in the first quarter of 2025, in large part as a result of the California wildfires, the industry was profitable last year, but now it's back to a loss. It's already lost $1.1 billion in the first quarter. Premiums increased 7.8% from the end of the first quarter last year, but the losses and expenses increased 15.8%. So we're back to having the losses basically increase at double the rate of the premiums. The right graph breaks the insurance industry down into the personal, commercial, life, and health. And what you can see is that the life and health and the commercial insurance sides are all profitable, but it's the personal auto and the homeowners insurance lines that have really been getting hit the hardest and losing money. As a result of some of those ongoing homeowners insurance losses and those cause insurers to exit from states where they're losing too much money, that then causes a growth in the residual markets, the markets of last resort, the state-run insurance entities where people go if they can't get coverage in the regular private admitted market. You can see from these slides, Florida has the largest residual market of last resort, and that's because Florida, over a course of time after Hurricane Andrew, they suppressed the rates. They had all sorts of problems with legal system abuse, lots of coverage mandates. At the time of Hurricane Andrew, 94% of homeowners policies in Florida were written by national carriers. Now only 18% are. And the Florida State Insurance Program, Citizens, has roughly 10% of all of the property insurance policies in the state. And you contrast that, the residual markets in Alabama, Georgia, and Virginia, very small in terms of the total policy count, which is on the left side, and the percentage of premiums that you see on the right side. Now, I don't want to pick on Florida because Florida's actually had some huge successes. So Florida in 2022 and 23 adopted several significant reforms for both insurance and legal system abuse, and it's turned its market around. So now the Florida market, residual market, is shrinking. Property insurance rates were the lowest increase in the nation in Florida this year. They actually decreased in inflation-adjusted terms. So the Florida market is still problematic, but definitely now trending the right direction. You contrast that to California, which is currently the state with the worst rate suppression for property insurance, and they now have the worst unavailability crisis in the state, excuse me, in the country. The unavailability of insurance in California has caused its residual FAIR plan to really explode. They call it a ticking time bomb. The state-run FAIR plan has had to assess the private insurers $1 billion to recapitalize themselves, and they're still in financial trouble. You also see on the lower right-hand graph, that's the California homeowner surplus lines market. So normally you buy your homeowner's insurance from the regular admitted regulated market. There's a surplus line non-admitted marketplace that's typically for the more specialized commercial risk, but in California, because a lot of homeowners can't get coverage in the admitted market, you can see the huge shift to both the FAIR plan and the surplus lines market because of the overregulation there. This graph shows the number of property insurance claims in the first quarter of 2025. You can see Texas particularly hammered. California had their wildfires, of course. But what's interesting here is you can also see Georgia and Florida had the third and fourth most claims in the first quarter of this year. And I highlight this because that's essentially where the market's going to be going over this next year. Those increased claims in Georgia and Florida mean there's going to be a lot more cost pressures on property insurance in those two states. So because of those massive losses, particularly in the personal lines industry, the independent ratings agency AM Best in 2022, for the first time in history, downgraded from stable to negative the entire personal lines home and auto insurance sector. And they warned that the personal lines insurance industry had lost tens of billions of dollars in each of the last 3 years. That includes the worst 3-year stretch of losses in recent memory for auto insurers and 5 years of consecutive underwriting losses for homeowners. Last December, AM Best upgraded personal auto back to stable. So we've seen the auto insurance really stabilize, and we're even seeing some competitive price reductions from some companies on the auto side. But the outlook for homeowners insurance remains negative. So they're expecting more losses for the homeowners insurance industry. The state insurance regulators, through the National Association of Insurance Commissioners, they publish annual data on insurer profitability. And the regulators' data indicates that countrywide, homeowners insurance roughly broke even over the last decade. Personal auto had a slight underwriting loss. Commercial auto had a significant loss. In Alabama and Virginia, you can see the results were much better over the last decade. That's why those markets have been relatively stable. But you can see the very significant underwriting losses in Florida and Georgia, and that's why those two states have had a lot of problems. Florida and Georgia in particular over the last decade have had very bad legal system abuse. That's particularly why the commercial auto, those big red columns going down, enormous losses. That's really gotten hammered by the legal system abuse, but both Georgia and Florida just very recently have passed legal system abuse reform. So insurers are a little more hopeful in those states that those results will turn around. I didn't want to mix our data in with the regulators' data, but our APCIA data based on S&P Standards & Poor analysis suggests that in 2024, the Alabama, Florida, and Virginia property insurance results improved significantly, but Georgia homeowners had a 44.9% underwriting loss in 2024, just really horrific, and commercial property a 29% loss. So again, kind of like the number of property claims I mentioned in Georgia, Georgia's clearly in for some real challenges over this next year. This previous slide was the underwriting results. This slide is the return on net worth, and again, this is from the regulators. That blue bar on the right over the last decade, that's the annual average return on net worth for the whole commercial sector. So if you were to invest in a very broad mutual fund, you'd be getting about a 15% rate of return. You can see the results in all of these states are much lower than that, but you can particularly see, again, that the Florida and Georgia results are not sustainable. I mean, it's roughly the equivalent of insurers putting money under their mattress would be just as well off, and actually better in the case of commercial auto insurance. And if you're not getting any sort of growth in your surplus, you're not, and your rate of return is essentially flat or negative, you're not going to be able to attract additional capital to meet the increasing coverage demands. Those rapidly escalating losses in states like Florida and Georgia, it's triggering a lot of questions about, is there an insurability crisis? Is insurance going to even be available? Is climate change going to make insurance unaffordable in the future? The short answer is insurance will continue to be available. Insurers can price the climate risk. They can manage the capital exposures, but the costs are going to continue to escalate from a number of factors. And this slide shows the sort of 3 tiers of cost drivers for property insurance. And in order, the most impactful are the macroeconomic pressures, and that's the economic growth, the 40-year record inflation, and the additional inflation for building materials and labor beyond the underlying CPI. Second tier impact is climate pressures, and that's not only increasing weather severity, but it's also a lot of people moving to areas that are more, have higher climate risk. So it's people moving either next to the forested area where there's wildfire risk, or they're moving to the southeastern coastal areas where there's hurricane risk, and a lot of people moving into tornado-prone areas. And then last, state governments can often escalate costs by increasing coverage mandates and suppressing rates and the legal system abuse, and those are all exacerbating the costs. So the left graph here shows the increase in global natural catastrophe losses, and those have roughly doubled over the last decade. So in other words, we're seeing twice as much disaster losses as we did a decade ago. But the right graph shows the increase of the cost of replacing all of the structures in the United States. So if you were to tear down every building in the United States and rebuild it, that would be the cost. And you can see that's actually more than doubled over the last 10 years. So the primary cost factor in the escalating property insurance losses, it's simply higher rebuilding costs. So yes, we're experiencing more severe weather events, but the biggest cost driver is that we keep making bigger buildings that become more expensive to replace. And you can see some of that reflected in the home values. I'm sure a lot of the credit unions are very aware of this. These charts are from the Federal Reserve Board. You can see how much the housing prices have gone up in Alabama, 85%, Georgia, 126%, Florida, 144%. Over the long term, home values are not a precise measurement for building costs, but over the long term, they roughly track, and the building costs are rapidly escalating, although it's slowed down a little bit. As you can see, all of these states had a big spike after the pandemic, both in the home values and the building costs, and then they've been slowing down a little bit in a number of states. While the economy in the Southeast has been booming, requiring a lot more coverage, inflation hit 40-year record levels. That's increased costs. The building material and labor costs have increased even more. And so the left graph, you can see the dotted lines here, that represents the home value index and the final demand construction inflation. You can see, again, a huge spike after the pandemic, and then it's been flattening out. The blue line is inflation, and the yellow line is from the Bureau of Labor Statistics, the homeowners insurance. And you can see there's always a lag time for insurance to catch up, because we have to file our policies with the states, get them approved, and then there's a 12-month lag time to roll over. Since we sell 12-month policies, you can see it's caught up with inflation, but it hasn't caught up yet with the increased building inflation. And on the right side, you can see, again, inflation compared to the roughly 60% higher material and building labor costs. And so that's a big part of why the insurance rates have gone up even beyond inflation. It's just simply because it costs a lot more to replace all of those buildings. This next slide, the darker area in the left graph, that shows the areas of greatest growth in wildfire-prone areas. And so you can see more and more people are moving into areas at risks of wildfire. On the right side, you can see the percentage of new homes being built in areas with higher fire risk. That's now a majority of new developments are at wildfire risk. So if we're going to keep building more expensive homes in areas that are prone to flooding and wildfire and hurricanes and tornadoes, then insurance is going to cost more money accordingly. Legal system abuse is also adding to cost, and that's especially hammering the commercial property insurance and the commercial auto insurance. The left graph shows the dramatic escalation in the corporate nuclear verdicts, and the right graph shows the recent spike in commercial liability losses and related other liability. And you can see just how far those losses, how much those losses have increased past inflation. So every now and then the trial lawyers say, oh, there's no evidence of legal system abuse. There's overwhelming evidence that the costs from the legal system are dramatically increasing, and that again exacerbates the increasing cost for insurance, particularly on the commercial side. One other very important component of insurance cost is reinsurance. Insurance companies buy reinsurance to spread their insurance risks into the global reinsurance marketplace. Reinsurance rates are driven by largely the same cost drivers as primary insurance. You can see that the reinsurance rates were very cheap. It was a soft market in the 2016-17 timeframe. So the reinsurance was cheap. It was at very low attachment points, essentially low deductibles for insurance companies. But you can see in 2022 and 2023 how much those reinsurance rates increased. That was because storms like Hurricane Ian, the global reinsurance industry lost 12% of its capital from those losses, and the rates had to increase and the attachment points increased. But you can see really the reinsurance market has restabilized, recapitalized, and you can see that those reinsurance, property reinsurance rate on line have actually flattened and recently declined. And that's a positive sign for the availability and affordability of insurance, property insurance. This graph breaks down the cost drivers item by item for severe convective storms. Severe convective storms are thunderstorms, hail, tornadoes. They've been increasing nationwide at about an 8% annual rate since 2008. And of that 8% annual loss increase, roughly 2.2% is from general inflation, 1.2% is from the additional inflation of the costs for building, repair, and material and construction. 2.3% is from economic growth. That's a good thing, but more economic growth means more activity. You need more insurance. It costs more. Up to 1% is from increasing weather severity, climate change. And then roughly 1.3% is from other cost drivers like legal system abuse and other regulatory costs. So overall, what you're seeing in the property insurance market is really just a simple demand and supply imbalance. The insurance demand is increasing because we have more expensive homes, inflation, higher weather losses, and legal system abuse. But the insurance supply is decreasing in real terms because the losses have been increasing faster than the rate. So that means that when you compare the capital to the GDP, it's been contracting and the profitability is too low to attract new investment. And so that's why we're seeing some availability problems in the heavily regulated states. In 2022, the US primary insurance industry lost $72 billion of capital. And it's recovered in nominal terms, but again, compared to the GDP, it's still trying to keep up. And that growing mismatch between demand and supply for insurance capital, that's why the independent credit rating agencies downgraded the auto and home insurance sectors. And that's why we've seen insurers pulling back from states like California are struggling, and states like Louisiana and Texas and recently Georgia. So what does that all mean for the housing and commercial property affordability? So on the commercial multifamily housing side, those losses have also been rapidly escalating from the same cost drivers as homeowners. But there's an additional caveat that the Surfside condo collapse in 2021 was a 5-alarm wake-up call for not only safety experts, but for insurers who realized that a lot of the commercial residential properties just weren't properly constructed and weren't being appropriately maintained. And it's created a lot of problems. A lot of homeowners associations had been trying to save money by deferring necessary maintenance, but that allows dangerous conditions to fester that can lead to severe losses and liabilities like we saw with the Surfside condo collapse. And so those multifamily housing units, the insurance has really been tightening, and the underwriting standards have become much more strict, including having appropriate maintenance. Broader commercial property risks are facing similar challenges, a lot of aging buildings and roofs, in some cases outdated plumbing and electrical. One of the biggest growing loss factors for both homes and commercial buildings is damage to roofs. For example, the size of hail balls on average has been getting bigger, doing more damage to roofs. And what we're finding is that even roofs that are sold as a 30-year roof, really the sealants become dry out and become brittle. And while older roofs aren't necessarily leaking, a lot of those older roofs, after about 10 years, they cease to become hail resistant or wind resistant, and they don't meet the current code standards. And that's where we're seeing a very significant percentage of the losses coming in. The commercial property also, we're seeing a lot more liability. Some of those commercial properties, a lot more litigation. One other commercial residential segment that's having a lot of challenges is churches and some of the nonprofits. They face a number of additional risk exposures. So, for example, sometimes just because of the cost, some of the necessary repairs and remodels and maintenance are deferred, or sometimes they're being done by volunteers who don't have the same expertise as licensed building labor. You also, a lot of nonprofits, like religious institutions, have some unique liability risks because they're open to the public and they're run by volunteers, and they house social services for challenging populations. And there can be some unique underwriting challenges with those. And there's also tends to be a lot less government oversight of those nonprofits compared to commercial institutions, appropriately for separation of church and state reasons. Some of the solutions that the insurance industry is focused on to try and bend the cost curve, and this is one of our top goals as an insurance association for our members, is trying to bend the cost curve. How can we make insurance more available and affordable for consumers? And insurers fund the Insurance Institute for Business and Home Safety. You've probably heard of the similar one, Insurance Funds for Cars, that does the crash testing and gives you car safety ratings. We have the same thing for properties. They put them in wind tunnels and they test them for wildfire and develop over time some very, very good building mitigation and resiliency standards. And so, for example, the IBHS has their fortified standard for wind that strengthens buildings against winds, hail, tornadoes, and so forth. And those have been proven to be very, very effective, which I'll get into in a minute. Insurers are also working to try and address some of the multifamily and affordable housing challenges by encouraging more mitigation, supporting regular inspections to identify risks early on. And we've been supporting about 24 federal and state grant programs and loan programs to help entities increase and improve their mitigation. And then we're working with a number of housing and lending sectors to try and coalesce around government programs that provide loans and grants or tax credits for climate resiliency, as well as trying to streamline some of the building process for properties that appropriately meet the current resiliency standards. And then as those building mitigation safety standards prove to be effective over time, many insurers offer discounts and make coverage more available. So, for example, in California, what we're seeing is after the wildfires, insurance coverage has become a lot less available for homes in the wildfire-prone areas. But homes that meet the IBHS wildfire prepared standards are the only ones that are having a relatively easier time getting coverage. And what we're seeing in the Southeast is that buildings that meet the IBHS fortified wind and hail resiliency standards are having a better time getting coverage from insurers as well. We had a recent test of the IBHS fortified standards in Alabama. So Alabama leads the nation with the most homes that are built to the IBHS fortified building safety and resiliency standard. Hurricane Sally hit Alabama in 2020 and was really the first test of the code's effectiveness. The Alabama Insurance Department commissioned a study that was just released, and it found that fortified homes that were built to the IBHS mitigation standards, had a 66 to 71% lower losses than the conventional homes. And the homes with fortified roofs had 50% lower losses than roofs that were built to similar standards, but without the same inspection requirements. So standards proved to be enormously effective, particularly where you had inspection to make sure that those standards were built appropriately. And those numbers are really a staggering testimonial to the success of the building standards and saving lives and reducing losses. And now we're seeing a number of other states copying Alabama's leadership in providing grants and incentives for rebuilding, mitigating some of the homes that are being built or rehabbed. We did a cost-benefit analysis of those IBHS fortified standards, particularly after the Alabama study. And what we've seen is that those standards increase the retrofitting of roof costs by about 6 to 16%. For new replacement buildings, it only increases the cost by about 1/2 to 3%. Those costs up front are much more than offset over time, though, by a combination of disaster loss savings and insurer discounts, as well as extended lifespans and higher resale costs. So insurers, as they see the success over time of these mitigation standards, you'll see the availability and affordability of coverage improving, as well as, again, the resale value of those homes. I was told some of you might be interested in some of the trends in lender-placed insurance. Not a huge amount going on there, but the state regulators, insurance regulators, adopted a new model act that codifies some of the best practices. It's only been adopted in 3 states so far, including Florida, but we expect several more to come on board. The NAIC also started requiring insurers to submit market conduct data on the lender-placed insurance. We haven't really seen a huge uptick in lender-placed insurance. It's a market niche that tends to be extremely quiet until there's a big financial economic crisis, and then it spikes up for a period of time. So we've only seen some minor increases in that, but if our country hits some major financial bumps in the next year, which I'll get into momentarily, then that could change, certainly. So some closing thoughts for you. Again, auto insurance, you saw some rate spikes corresponding to the increase in the cost of autos and auto parts from the deterioration of the global supply chain after the pandemic and the high inflation. But the auto sector is really stabilized. And again, many carriers are now reducing rates or having very minimal rate increases. That market is expected to remain soft, with a big caveat of wild card of tariffs. If the tariffs are long-term, of all of the financial markets, it's expected to have the greatest impact on the auto insurance costs. So it could increase auto costs in the high upper single-digit percentage range if those tariffs are long-term. Property reinsurance rates are declining, but the primary rates are still catching up in several states. And again, I pointed to states like Texas and Georgia, where we've had unusual losses. And so insurers have been trying to catch up to the escalating losses in those states. And then while the property insurance rates across the nation are finally starting to stabilize and moderate somewhat, We are seeing a spikes in the liability costs, and that's going to create worsening problems for commercial property and commercial auto insurance. And then I think one of the broader financial concerns we have, and this is something that probably all of you are more expert in than I am, but with the consumer debt at an all-time high and a tidal wave of student loan defaults about to crash onto the financial markets, if you combine the cost of inflation and interest rates and rising insurance, even if those are all increasing more slowly in 2025, they're all increasing more rapidly than the consumer's average wage increases. And so I think we're very concerned that in the short term, the financial challenges are going to get worse for a majority of consumers, and that's going to really trigger a lot more political activism against the financial industry, the lending community, and the insurance community. And so we're doing a lot to not only try and fight that populism, but again, we're also working to find ways of bending the cost curve and through more mitigation and education, trying to make the insurance more affordable and available. So how to help? APCIA and the Reinsurance Trade Association, the RAA, we're conducting a series of roundtables with housing groups to understand each other's concerns and coalesce around consensus solutions such as mitigation and risk education and the kind of coverage requirements both on the insurance side and the lending side, and to jointly develop materials that can be used both for consumer education, for example, providing insurance materials to the realtors and the lenders that you can provide to consumers when they're buying or selling a house to make better educated decisions. And as well as on our side and working with the regulators and then using those for advocacy. So we'd love to have a partnership with the credit unions in those roundtables as we go forward. And with that, I'm very happy to take your questions and comments.
Thank you very much, Robert. Really appreciate all this information. I think it's been a great education and learning for our credit unions and also some of our employees at TruStage who are on the call as well. And so with that, if you have a question, please just use the raise a hand function, or you can drop it in the chat. I've taken have already come in through the chat. If you have any right now, please raise your hand. Robert, first off, we had a question in the chat about what does legal system abuse entail? And I think Casey was able to answer that adequately in the chat, but if you have any more thoughts on what is legal system abuse?
Yeah, we're still working with some of our partners like the Chamber to understand exactly, get a precise definition. Swiss Re and others have shown that the costs of the legal system are adding about 7% to cost beyond economic inflation. So if inflation is at 3%, we're seeing that social inflation, the added litigation costs, are another 7%. That results in a tort tax cost to the average American family of, I don't remember the exact number, but it's in the $4,000 to $5,000 range annually, and higher costs of goods and services. And then I go back to the chart I showed you of the commercial liability costs that have skyrocketed at several times the rate of inflation. And again, that's because of the increasing legal system abuse. Some examples of that, we've seen an enormous amount of fraud. We're just about to put out a publication on staged auto accidents that are occurring, and lawyers that have tried to abuse the system by filing false claims or saying they're representing consumers that don't. We're seeing it in the assignment of benefits has been one of the huge issues where I'm a Florida resident, and I have all these contractors who left leaflets at my house saying, essentially, we can get you a free roof and get your insurance company to pay for it. Just assign your benefits to us and we'll handle it for you. Florida and Georgia have enacted significant reforms. And again, in Florida, it's been incredibly successful, going from the most dysfunctional insurance marketplace to actually now having the lowest increase in property insurance costs and a lot of new insurance carriers coming into the market. So There are different ways of defining legal system abuse, but at the end of the day, it's the United States is an enormous outlier. We would ideally want a legal system that's fair and timely and efficient and provides justice for everybody, but it really doesn't accomplish those. We're a huge outlier and spending far more than any other country on litigation costs, and an outsized percentage of those goes to enrich the lawyers and pay the court costs, and tends to result in much longer claims delays that are unnecessary. One of the particular issues we're working with some of the regulators on is that the majority of policyholders who hire attorneys do it before they've even contacted their insurance company. So there's already a system. If you get into an auto accident, you can call your insurance company, they'll resolve the claim. You can talk to your agent to help resolve it. And if it's not resolved to your satisfaction, you can go to the insurance regulator and they can help you resolve it. And then if none of that works, you can go to a lawyer. But too often with all the legal advertising, people are jumping immediately to the lawyer, and that means they're going to lose a third to 40% of their compensation right off the bat, that lawyer, and it may be completely unnecessary, and there's already a system to resolve disputes in the system. So that's become a major cost driver in some of the lines, like the liability lines, that hopefully we can get some reform on over time.
Yeah. Yeah, and it's hurting consumers, right? I think you're seeing policies increase, or they're not getting the full benefit of that policy because the lawyers take that 30% off the top of it, and so it's a real issue for consumers. That we have is since fire risk has increased nationwide, why not spread the risk for a national program like we do for flood?
Well, the flood program is not exactly an example of success. It's I think on its 33rd short-term reauthorization, desperate need of reform. It's if I can remember the numbers right, somewhere around $22 billion in debt, and that's after double-digit debt forgiveness by the government. Right now, the insurance programs are reinsured through the global markets. So there's about $1 trillion, a little over $1 trillion, about $1.1 trillion of surplus in the insurance industry. There's about $750 billion of additional capital in the global reinsurance industry. So right now, wildfire risk is being spread around the global capital markets, and there's plenty of capital for that. And if you were to put it in a government program, it's not going to reduce the risk at all. It's just going to be less efficient and less of a risk spread. The real problem with fire insurance just tends to be particularly states like California, they've been suppressing the rates. It takes over a year to get an average policy approved in California by the regulators. And so insurers are always struggling to catch up. And historically in California, it's the only state that hasn't allowed insurers to reflect the reinsurance costs in their rate filings, and they haven't been able to use CAT modeling in their rate filing. So it's not an insurability problem per se. What's interesting is as the IBHS has developed wildfire-specific standards, and this is something relatively recent, the most cost-effective thing that communities can do, property owners can do to reduce their wildfire risk is simply clearing a 5-foot defensible perimeter around their building, which just means moving all the trees and shrubbery 5 feet away from your building. Very, very cost effective. Ironically, California had actually passed that requirement for buildings in fire zones in 2020, but they hadn't implemented it. They never issued regulations. So there's a lot of very sensible, very cost-effective mitigation that can be done by wildfires. We don't really need a government program for it. We just need to do it. Just need to do the mitigation.
We're coming up on the 45-minute mark, but Larry, I saw your hand raised. Do you have a question for Robert as the last question before we close out?
Well, I hit the button by mistake. I was just looking at the chat, but I do have just a thought. So actually, we attended a Consumer Federation of America meeting where they were talking about these same subjects. And I think that there's a lack of understanding of how an insurance company gets a rate set. So if there's a company, an insurer, wants to files a rate charge, what happens? How did they go to the? Let's use California's example because you've been talking about the suppression there.
Yeah, California has one of the most problematic systems, which is again why a majority of the top property insurers in California have been pulling back from the market over the last few years after a decade of losses. And in California, an insurer has to identify the cost trends, you have to document them, and then you have to file them with the regulator. The regulator, before you can use them, the regulator is taking roughly a year on average to approve those rate increases. And then the insurer has to wait another 6 to 12 months, even after the rate is approved, for the policies to turn over so you can implement it. And what that means in California is that insurers are typically a year and a half plus behind what the cost trends are. And so the skyrocketing inflation in 2022 really is what spiked the rates in 2024. California is a bit of an outlier. Colorado is sort of the next worst in terms of how long it takes. And then most states, either some of them like Illinois, don't have advanced rate review and yet still have under average rates, or they only typically take a few months. But it still does take time for insurers to see the trend documented. And even if the state has a short review process, again, you have to wait that 6 to 12 months for your policies to turn over. So it's not like a grocery store where you can adjust your rate on a daily basis, or a gas station. Insurers are always lagging those inflationary cost increases. And that's why you're seeing, again, the inflation spike in 2022 and 23 is really hitting the insurance market and the rates in 24. And then now you're seeing them, the rate increases starting to moderate. And states like Florida that have done a really good job addressing legal system abuse, the rate increase was 1%, which is after inflation, actually a rate decrease.
I'm seeing we're over time now, and so I just want to say thank you to Robert for joining us today. I want to say thank you to our credit union friends at the league, their credit union members, and I also want to thank the TruStage folks that are on the call as well. If you have any additional follow-up questions, you can filter them through Matt or Christopher. He can get them to me, and we can pass them after today going forward. And so we appreciate everyone's participation. Matt.
Yeah, and just to close out for everybody, thank you, Robert. That was fantastic. I will put my email in the chat box. I've gotten some of you asking for the slides. We do have those. We also did, as I said, record this, so we can send that out. All you got to do is ask me, and I'll get it to you ASAP. So there is a little bit of a delay with the recording. We do have to process it. It doesn't usually take that long, but I can get it to you pretty quickly. I'll put my email in the chat now. And Robert, is there anything else you want to add before we go?
No, just one last pitch. Again, we're having this series of roundtable with the housing groups to try and work together on understanding each other's problems and solutions. Loved TruStage has been such a leader for us, so feel free to go through them or to go come to me directly. But we'd love to have your partnership in those discussions.
Thank you.
Thanks, everybody. We really appreciate it. Have a great day.
Thank you.
Thank you all.